All right, let's talk about a company that's almost certainly hiding in your pantry right now, Mondelez. We're going to try and figure out if this absolute snack giant is an undervalued gem or if there's maybe some trouble hiding behind that shiny wrapper. Let's get into it. I mean, come on, you know these names. We're talking Oreo, Cadbury, Ritz crackers, Toblerone. These aren't just snacks, they're global icons. They're what you reach for when you need a little comfort, a little treat. And believe me, that brand power is a huge, huge piece of this whole story. But here is the central puzzle, the thing that's so interesting about Mondelez right now. The revenue, the total cash coming in the door, it's actually going up. Why? Well, mostly because they're charging us more. But, and this is a big but, their profits are getting squeezed. So they're making more money, but keeping less of it. How does that even work? Well, this is what we're calling the snack giant's squeeze. Let's really dig in and unpack why bringing in more cash doesn't automatically mean you're more profitable. Okay, so the number one villain in this story is something called input costs. That's just a fancy way of saying the price of the raw ingredients you need to make your stuff. And for a company that makes a ton of chocolate, the biggest, most painful input cost right now is cocoa. The price of cocoa has just skyrocketed, and it is eating right into their bottom line. And you can really see that pressure when you look at their own forecast. The company is saying that for 2026, revenue growth might top out at just 2%, or it could even be flat. Now, that 2% ceiling is way, way below what analysts were hoping for. It's a huge signal that Mondelez is buckling up for some pretty tough times ahead. So that kind of leads to the big question, right? With profits getting hammered and growth looking pretty weak, is there anything to be positive about? Is there any good news to be found here? You bet there is. Let's flip the coin and look at the other side of this. We'll call it the case for an upside. This is why some people are looking at the exact same situation and think all this pessimism is just way overblown. So the optimists, they point to a few really powerful strengths. First, all those brands we talked about, they give Mondelez pricing power. Second, there is massive potential for growth in places like China and Brazil. They're also getting smarter with their marketing, using AI to be more effective. And maybe most importantly for investors, this is a company that has a long history of giving money back to shareholders through dividends and stock buybacks. And this chart really gets to the heart of that undervalued argument. It shows the price-to-earnings ratio, which is basically a quick way to see if a stock is cheap or expensive. And as you can see, Mondelez is trading at a lower multiple, a discount, compared to its competitors. People who are bullish on the company look at that, and they don't see a problem, they see a potential bargain. And hey, this isn't just some fringe idea. The pros, the financial analysts who cover this company day in and day out, they seem to agree. The consensus rating from them is an overall buy. They're basically saying that they believe the current stock price just doesn't reflect the company's real long-term strength. But of course, it's not all Oreos and cream. Let's get real and look at the other side of the debate, the very serious challenges we're calling headwinds and high prices. And these risks are no joke. That crazy cocoa price is number one with a bullet. But then you have the risk that shoppers just get fed up and stop paying these higher prices. You've also got fierce competition from cheaper store brands. And because Mondelez is global, they have to worry about things like currency swings and the overall health of the world economy. Oh, and yet there's that little long-term trend of people trying to eat healthier. And here's the result of all those risks playing out in the real world. While they've jacked up prices, their volume/mix has gone down. Okay, what does that mean? Put it this way, they're selling fewer cookies and chocolate bars. And even if the total dollars they're making goes up, selling fewer actual items is a major warning sign that your customers are starting to back away. Okay, so we've heard the bull case and the bear case. Strong brands versus soaring costs. Let's pull this all together now and really focus on the deciding factors. This table really lays out the whole debate perfectly. On one side, you have the bull case, a discounted stock, a great history of shareholder returns, and powerful cash flow. But on the other side, the bear case is just as strong. You can't ignore the cocoa costs, that weak forecast, and the very real risk that shoppers are just gonna change their habits. So what does this all boil down to? If you want to follow this story, here are the 3 things you absolutely need to keep an eye on. Number 1, commodity costs. What happens with the price of cocoa? That is the biggest question mark. Number 2, brand resilience.
How strong are brands like Oreo really? Are they strong enough to make you keep paying more? And that leads directly to number three, consumer behavior. What are you and I actually going to do in the grocery store? All right, let's bring this home. We're going to take this huge, multi-billion-dollar corporate drama and boil it down to some final food for thought. You know, when you strip everything else away, the entire story of Mondelez right now comes down to this one simple tension. It's the emotional power of brands we love versus the cold, hard reality of high costs and tight family budgets. So, I'm going to leave you with this one question to think about. The next time you're in the cookie aisle and you see that your favorite snack costs a little bit more, what's your move? Does your brand loyalty win out or does your budget? Because the answer to that question, multiplied by millions and millions of us around the world, is what will decide the future of this company. Thanks for tuning in.